We're in finance, and this is developing a financial forecast and budget. So today we are going to go through the importance of financial planning and budgeting, the key components of a financial forecast. We're going to create realistic and flexible budgets, and we're going to go through some tips for monitoring and adjusting your budget throughout the year as well. And that would obviously include your finance meeting, your weekly finance meetings. So let's jump straight in to move my little noggin out the way. The importance of financial planning and budgeting. So we can see on the right-hand side, we have got our financial forecast template that I've got for you there in the blueprint. And what we want to do is we want to ensure your financial stability and growth by using this financial forecast. So financial planning and budgeting are so crucial for the financial stability of your company and the growth of your business. A well-designed financial plan helps to set a clear financial goal or clear financial goals, identify potential challenges, and develop strategies for long-term stability and growth. By aligning financial planning with your business objectives that you've already set in the strategy section, you can ensure that your business has the necessary funds to operate efficiently and expand over time to meet your objectives. Budgeting also plays a crucial role in your growth, and it allows you to allocate resources towards growth incentives like new equipment, vehicles, plant, machinery, marketing campaigns, additional staff members, managers, another layer of management, all those kind of elements. This is where you can build out your financial forecast in order to factor in those elements so that you can see whether your company will still be profitable. You could see changes in gross profits, you could see changes in net profit margins, and we're going to go through all of that in the finance section here. So, making informed decisions based on the financial data that you can find out from your financial forecast. So, financial planning and budgeting aims to provide vital data so that it can inform your business and inform your business decisions. Throughout financial planning, you can forecast future revenues and expenses, assess the financial feasibility of strategic initiatives, and make informed decisions about investments and financing options. Similarly, budgeting provides a roadmap for your business's financial operations. By comparing your budgeted figures with actual results, then you can identify variances, understand their causes, make data-driven decisions to improve performance, and it helps to manage risk and improve efficiency and increase profitability. So although finance, the topic in general, everybody goes, "Ugh, I'm not good at numbers, I don't really like that." This is exactly where we can see in real data how your company's performing, what areas are lacking, what areas are succeeding, and then play to our strengths and get support for our weaknesses. So part number 2, the key components of a financial forecast I've got highlighted here, the section that we're going into. So this is projecting revenue based on sales, pricing, and market trends. Revenue projection is an essential component of a financial forecast. It involves estimating the money your business will generate in a specific period, typically a fiscal year, broken down in month on month. This is achieved by considering a few different factors. There's your sales, analyze your historical sales data and consider factors that could impact future sales, such as new product launches, new service offerings, different market expansions as well, and also your rate of growth. There's also pricing, evaluating your pricing strategy. Are you planning to increase your prices? Are you going to keep up with inflation? If so, how will this impact your sales volume? Similarly, if you plan to offer discounts or promotions, you need to factor these into your price projections as well. So if you're giving away, let's say a big example, if you're giving away half of your jobs are 2-for-1 jobs, then you're going to be losing a lot of your income to 2-for-1 jobs. If you're increasing your price by the inflation rate alone, that means you're not factoring any growth. So you want to be adding in whatever the annual CPI is, plus whatever you anticipate to grow as well. That's just an important point to think about when you're revenue forecasting. And also market trends. So you want to look at broader market trends that could impact your revenue. This could include changes to customer behavior, economic trends, industry-specific factors like construction industry downturns or construction industry booms like we've just seen recently. You really want to be playing this is a good time to give consideration to those market trend elements, however vast they are. Now, estimating our expenses. So we've gone from our income, now we're going down to our cost of sales and our expenses. These include obviously your fixed, variable, and capital costs. So, expense forecasting is another key component of your financial forecast. It involves estimating all costs associated with running your business, including the fixed costs. They are the costs that do not change with the level of output, such as your rent, your salaries, your insurance, the things that don't change regardless of how much revenue you do. Then you've got your variable costs. These are often your cost of sales, and these change in proportion to the level of business activity or the amount of revenue you do. For example, if you're using materials or direct labor costs and sales commissions, these are going to be variable depending on how much revenue you do or how much business activity you've done. And then we've got capital costs. These costs are related to the acquisition or maintenance of long-term assets like buildings, equipment, land. They can be vehicles as well, hire purchases. It's crucial to be as accurate as possible when estimating your expenses to ensure your financial forecast is as realistic as possible. Now, the reason we didn't say that in forecasting your revenue is because forecasting revenue often feels like how long is a piece of string, whereas looking at your expenses, you can almost always go, this is exactly how much it's going to cost, unless you open up the wallet and spend more. Now, we're looking at calculating profit projections. So I've just got to get my head out the way here. Calculating profit projections to determine business viability. Now we're going down to what is called the bottom line or your net profit. So profit projection is the final step of preparing your financial forecast. Once you've estimated your revenue and your expenses, you can calculate your expected profit. Now I've done these formulas for you in the template, but this is done by subtracting the total expenses from the total revenue. Your profit projection gives you a clear indication of your business's viability, how much money is left over. If you project if your projected profit is positive, your business is expected to be profitable. If it's negative, you need to revisit your revenue strategies and your costs and expenses and get it to a point where it is profitable. And regularly updating your profit projections and comparing them with actual results can also provide valuable insights into your business's financial performance and help you make better informed strategic decisions. So, going on to creating realistic and flexible budgets. So now, setting budgets, priorities, and being flexible. We want to create a realistic budget, and creating one begins with setting appropriate targets based on your financial forecast. Sorry, my head's in the way. The target should be achieved or should be achievable, yet ambitious enough to drive performance. So we don't want to set things that we know are definitely going to happen, because if we fall short of those, we'll be less than our expectation. However, in the other side of it, we don't want to set things that are too aggressive, because if you scale up in order to reach those, it could be detrimental if you do not reach it. And what I mean by that is if you say you want to do $1 million next month, and then you go out and you hire 5 project managers in order to do that, and you don't do $1 million next month, you do $10,000 next month, you still have to pay all of those project managers' wages, and it will no doubt really, really be detrimental to the bottom line. So that is a massive example, but I hope that gets through. And budgeting is not just about controlling expenses, it's also about strategically allocating your resources to drive growth and competitiveness. This might mean investing more in areas that directly contribute to these strategic objectives and less in other, less critical areas. While it's important to stick to your budget, it's equally important to be a little bit flexible and adaptable. Remember, the budget is a tool to guide your decision-making and business operations. It's not something that is fixed, put on a bench and never looked at again. Now, the review and adjusting. To effectively manage your budget, it's crucial to regularly review your actual financial performance against your budgeted targets. Now, we do have cash flow conversations in our weekly meeting agendas, but this is really what we're thinking about here. We're thinking about the financial reporting in our governance meetings. So we're looking at a month on month, and also at the end of quarter, we want to look at that quarter to date during the month, and also at the end of each quarter as well. So during your budget reviews, during your governance meetings, pay close attention to any areas where you're consistently overspending and also underspending. Your monthly governance meeting is where you're going to go through and do these reviews. Your quarterly strategy is where you can adjust them. So what I mean by that is I want you to identify and have conversations around it in your governance meeting, but I don't want you to adjust your financial forecast every month. I want you to make sure that you stick with the pain of if you weren't correct during that period, so that it becomes or drives home the idea that you need to think about your financial forecasting on a quarterly basis, so that you are then reminded every month on month throughout the quarter if your budget is not where it should have been. So it's almost like a little bit of a salt in the wounds, a reminder throughout that quarter. But it also means that you're not just constantly making adjustments to your financial forecast as well. So remember, the goal of budgeting is not just to control your spending, it's to optimize your resource allocation and financial performance to support your business's success and growth, and ultimately achieve your objectives, your mission, and your purpose. So there we go. We've got the key components of a financial forecast. You know how to create a realistic and flexible budget, and you've got a few tips there for monitoring your own budget as well.